Panel, I'll invite David Kotok up to introduce the panel on technical analysis in the stock market.
Thank you, Don. Come on up and sit down, Alice. I see Leo and I see Katie coming up. At the Financial Literacy Day in April in Sarasota, this panel and discussion were very popular. The panel has nothing to do with trade wars, no Federal Reserve policy. This is a panel of 3 experts, 3 practitioners, and their day-to-day jobs include the movement of stock prices. And in the Q&A, you may ask them why, and they may or may not answer. This doesn't have to do with the why. This has to do with the movement of stock prices. Now, we reassembled the Sarasota panel in a little different format. Just a quick word, bios are in here, so I'm not going to read them. 3 practitioners, all doing different things, dealing with the movement of stock prices. Who's going first? Let me see. Katie. So Katie has a service. You know her. You've seen her on television. She's got a distinguished career, and she now has a service that deals with the movement of stock prices, and I'll let her present her work, that benefits investors who focus on that sort of thing. Alison is a wealth manager, and we know each other for quite a while, and she applies her techniques of choice in decisions to buy, sell, and hold the movement of stock prices. And Leo is a math professor and also is a quantitative guru in our shop, and he applies math, and he can decide if he wants to talk about a Bayesian framework or not, in the movement of stock prices. So we're going to have 3 different views, 3 different approaches, practical applications dealing with the movement of stock prices. And I will stop talking and ask Katie to go first. Each panelist has agreed in writing to limit themselves to 15 minutes to give you a chance or 2 for a question before we end this session. Okay.
Thanks, David. Hi, everyone. It's an honor to be here and amongst a lot of economists with their long-term time frame. Of course, we tend to focus a bit more short-term, so we're going to fill in those blanks and try to harness some of the volatility in the markets. So again, Katie Stockton. I'm a CMT. So CMT is essentially our version of the CFA. We look at charts to try to understand the supply and demand behind any security. So really just price-based analysis, occasionally looking at volume as well. We like to keep it very, very simple. And of course, it's a very visual science, or I would even say a visual art that we use. It's a great complementary discipline, something that enhances what you already do. And that's why I think it's important to bring it to this forum where you build your views. Maybe you build them using macroeconomics or maybe using fundamental analysis, but how can you time those entries and exits? And how can you understand how, at times, the stock market may not behave in the same way as you expect it to based on, say, the fundamentals of that company? So we can try to help fill in those blanks, not only on different time frames, tends to be a bit more short term, but also in terms of, what is happening, the supply demand behind those securities. So coming to the Rocky Mountain Economic Summit, I was sort of inspired by the mountains to show one of my favorite charts here. And this is called the CNN Fear and Greed Index. It's a gauge of market sentiment, and it's trying to understand the cycles of fear and greed in the marketplace. at the end of the day, a market is driven by human emotion. That's how we get these peaks and troughs, and this is just one way that we measure that and try to understand whether a market is so-called overbought or oversold. As it stands, this is really based on U.S. equities and transactional gauges of sentiment, things like the volatility index or VIX that you've probably heard of, junk bond demand, things like that. Things that are actually not just about how people are feeling about the markets, but how they're actually positioning in the marketplace. And we can get an understanding of that by looking at this visual gauge, which is not really sending a loud message at this time, but if anything is closer to oversold territory as we come into what I believe was a very important low for the major indices. So we'll move on from here. Here we go. So I tend to approach the market like many economists from a top-down perspective. I think that's important because if you're right on the market that you cover, then you're probably going to be more right on the securities that you're using to trade or invest in that market. So to have that top-down view correct or close to correct, you'll obviously be better off in your investing and your successes there. I think technical analysis as a discipline is really fantastic for risk management, and isn't that all, what we're all trying to do at the end of the day, trying to understand where there's opportunity and reward and what's our downside for taking that position. So risk management, a very important concept. We also look for opportunities. So looking at the charts, we try to find, hey, listen, that looks like it's a basing phase, something that's turning around. If we're a value investor and want to know when that stock is ready to get going, the charts can really help you do that. Market timing is a big element of it. It used to have sort of a negative connotation. Now I think people have embraced it and realize that market timing should be done at all times, really. I can't imagine investing in anything without understanding, at least in the public markets, without understanding what the chart looks like and trying to time and understand those entries and exits as they pertain to things like support and resistance. Support and resistance, that's potential areas of buying pressure and selling pressure, can be gauged any number of ways, and I'll show you a few of those how I do it. We also use relative strength as a concept, so looking at relative performance between whether it's two asset classes, a stock and another stock, sort of a pair trade idea. That can be invaluable as well. And we use a lot of tools to arrive at our views. So I tend to be somewhat of an indicator-oriented technical analyst where I like the mathematical sort of elements of it. Some technicians just use moving averages, and that works for them. I get a little bit more complex without getting too complex, sort of just complex enough to keep people coming back to me and reading my research, I guess. So we have a mystery chart here. Does anybody have a sense of what this chart might be of? All right, we got some winners back there. So I figured it may come up at some stage today. And of course, it's just really a fascinating chart. You saw the run up and, it's the closest thing that we have to a bubble, of course, in this, recent past. So I think that's pretty fascinating. And you can see just how that acceleration resolved itself, and what can still in some ways be construed as a corrective phase, as a retracement, but based on some tools like that shaded gauge you see there, that's the cloud model that I use, it would tell you that Bitcoin is now actually in an established downtrend, such that the next relief rally that we see in Bitcoin, it should meet resistance in that, 10,000 area where that cloud model resides, as just one example of how we're using these charts. So in practice, technicians are somewhat known for being emotionless in the way they approach things. And I think for me, as just really a purist, when I approach it, it's somewhat true. I don't tend to get married to my views or my positions because, quite honestly, I haven't spent a lot of time developing them. All I need to do to have an opinion is to look at a chart. And that's sort of a nice way to keep it simple, right? But to have that understanding of where that stock might go, where that security might go, really I can drive that solely from the chart, so I don't need to dig into the balance sheet. Ideally, you take that analysis and you combine it with the fundamentals, and then you can have more things sort of in your corner and you can be a more successful investor. So while I am a purist in the way I approach things, I'm not a money manager. I would give my money to somebody who does a little bit of everything, sort of incorporates all the disciplines. And discipline is an important word here, where I think to have a methodology is really the most important thing. it almost doesn't matter what that methodology is. I think everybody has their own tools that work for them, whether it's a different time frame or whatever, different asset class that they're focusing on. It's about having a discipline and a methodology that you come back to over and over again, because what you can derive from that is, well, these indicators tend to work better in this environment, and sometimes they'll fail me. There is no holy grail, we know that. So we try to understand how the indicators can help us in different environments. And the only way we can do that is by going back to the same tools over and over again. It doesn't mean you don't continually educate yourself about what's out there, but to be disciplined in how you approach it and try to back test and really understand the nature of the indicators that you're using. We, of course, have gotten a bit more press than we used to in the media, technical analysis. It's really become somewhat mainstream. And I think the media likes it because we can talk about anything. So anything that has a price, we can have an opinion on. But really, the reason we do it is because it works. I think that at the end of the day, trend following, especially in a trending environment, is really a valid discipline. So, there are so many white papers out there on the discipline. Of course, they're all very specific in what they're analyzing. Andrew Lowe at MIT is very well known for really having sort of bolstered technical analysis on the academic side of things. And what I like, he said one time, pattern recognition is one of the few repetitive activities for which computers do not have an absolute advantage yet, right? So certainly there's technology has really, really helped, sort of forward the discipline and made it so that our capacity is so much greater. But even still today, artificial intelligence, machine learning, there's been no replacement of what we do, and really, which is such a visual art, yet. So, I'm sure there's a lot of people working on that, me not being one of them, but, it is such a visual art, really. It's just about looking at the charts and trying to understand, based on your experience looking at the charts, where things might go next, or at least what your risk might be. And that visual nature appeals to some folks, not to others. But, the key in delivering the message, of course, to clients, I tend to talk to mutual funds and hedge fund managers, and you don't want to get too technical in how you, explain it, just not to get too deep into the stochastic oscillator, but really that's where it's coming from. So I'll show you some charts. Actually, let me first give you a sense of what my toolbox looks like. Support and resistance being that primary concept. Just examples of how we identify support and resistance, moving averages, that cloud model you saw in the Bitcoin chart, Fibonacci levels, if you've heard of those. Trend lines, of course, very standard. You may have heard of our price patterns, double bottoms, double tops, head and shoulders tops. Some of these give us, sort of make it seem sort of silly, right? But at the end of the day, they're trying to explain a concept of support and resistance. And then, of course, we're using a lot of indicators, trend following gauges, mostly moving average based. And then the stochastics would be another tool, trying to understand if something's overextended one way or the other. And then that relative strength analysis as well comes into play. And finally, when I look at the markets, I also look at the market internal measures. So that's things like breadth and leadership and sentiment. You saw that first sentiment gauge, and you'll hear a lot about that in the media because those are the types of things that tell the story of the marketplace. But as David said, we're not here to answer why. We're here to talk about what's going on and what might happen next. We're not trying to understand what's driving these trends. We'll leave that to other folks, but rather to understand how, they might impact the charts and the price of that security. So to apply some of these to the current market, if I have a little more time here, I tend to be, like I said, US equity centric, and you'll see here, if it skips forward, a monthly bar chart of the S&P 500 index. This monthly bar chart, you can see the uptrend, right? So as a technician, it's very difficult right now, I think, to be bearish. There are certainly some of those out there because we all have our own methodologies, and mine tends to be more trend following and momentum based. So I'm quite bullish based in part on this chart. So we have ways of understanding momentum aside from just looking at the visual, but you can see an uptrend there. And in the bottom window, that's a very popular indicator called the MACD. It's moving average based. When you get crossovers in that indicator, it's a buy or sell signal. It's really just designed to eliminate noise in the marketplace, and it's it's kind of pinched towards the sell signal. If it were to flash a sell signal, we would heed that as a reason to be more cautious regarding U.S. equities, because you can see where the bars are colored red, that's when that indicator was on a sell signal in the past. And that dictated some more caution if you look at those environments covered the sort of early 2000s, 2008, et cetera. So those would have been, very good times to manage risk in your positioning. Go back the other way. So starting top down, from not only from the S&P down to the individual stocks, but also on a time frame basis, we start long term, understand our long-term bullish biases there, and then we sort of drill in and get into the intermediate term and then the short term. So the intermediate term view you can manage using the same tools that you use on the longer term charts and try to understand what momentum is doing on an intermediate term basis, which tends to be a really relevant time frame for investors, where if you miss sort of a quarterly type move these days, you can really underperform your peers. So we right now have positive or improving momentum here and also globally based on the intermediate term gauges that we track. You also have this great little triangle breakout in the S&P 500. You can see that there, and what was recently an overbought condition, but it was worked off with the recent pullback. On the daily chart, you can see that sort of drilled in, it becomes somewhat fractal. You can apply, again, the same gauges here. And on the stochastics, which is the middle window there, when those stochastics dip below 20%, that's when we have that measurable oversold condition. You can see it doesn't happen all that often. So when we say oversold, we're not just throwing that word around like some folks do, but rather it's measurable, and it's when you have that oversold upturn that you tend to have buying opportunities in U.S. equities based on this chart alone. And then when you have a corresponding momentum buy signal or MACD buy signal, that's when you have most odds in your favor from a technical standpoint. And if you can align that with your fundamental view, then I think you're really in a good position. So sector rotation, super important, and this is a really neat sort of visual gauge of that sector rotation that we all know exists in the marketplace. Very short-term view that I show just because it has that beautiful clockwise rotation to it. These are the S&P 500 sectors compared to the S&P 500, all normalized. The x-axis is price-to-price ratio, and the y-axis is a momentum reading of that ratio. And you get this great clockwise rotation where you can see anything that had pointed up and to the right had outperformed the broader market, exhibited leadership. But you can see as they turn, that's where they're losing upside momentum. So notice here, utilities way off to the right, real estate, or REITs, consumer staples have all lost upside momentum. So that means that defensive positioning that was characteristic of the pullback that we recently had is now sort of dissipating, and we're getting more offensive positioning. Financials, industrials, materials in the very near term, based on this look, are most attractive. Okay, 2 minutes, sure. So when you look at those trends, just on a relative basis, when you actually visualize that in a non-normalized format, you can see how important it is. We all know that technology in the US has really exhibited upside leadership. You can see that in sort of the bottom middle chart right there. In the lower window, that's a ratio of the technology benchmark to the S&P 500. It's a very well-established uptrend. You also see one in consumer discretionary, which is upper left. But notice consumer staples, which is middle upper. That's a pretty decisive downtrend from a long-term perspective. Industrials has somewhat broken down. Utilities, it's a long-term downtrend. So you can really see how these trends are manifesting themselves on the sector front. And of course, that's going to be very important to investing. So I think it's very key to have that sector bias correct based on that relative strength analysis. And breadth, this is market participation. So how many stocks are up on up days, down on down days, and how does that relate? This is a cumulative advanced decline line, so it's gauging that on a cumulative basis. And boy, there's no problem here, right? So some people have criticized the market as having narrow leadership, and while that might be the case on the sector front, it hasn't meant that the stocks aren't actually up on up days. So that's important to a strong tape as well. And I will tie it up here. This is something that we publish in our daily note, and it's an aggregate look at the market internal measures that we track. So measures of breadth, leadership, sentiment, et cetera. And we actually kind of ignore this table until or unless it flashes a lot of green or a lot of red, and that green or red are the extremes in those readings. And you can see the last time we had a lot of green, or not a ton, but enough, April 2018. So we had a pretty important tradable low for the S&P 500 then, November 2017 before that, and then of course February 2016. So we've had a lot of important lows that have been captured by these market internal measures, which are mostly contrarian in nature. So we have ways to sort of enhance or otherwise what we're seeing from a momentum perspective or from an overbought, oversold perspective. And then it's all in how you take this information and sort of roll it into your views. We, of course, I know I'm limited on time now, but we, of course, look at other asset classes as well to enhance, again, or otherwise, our views on U.S. equities. Of course, yields will be very important in that regard, just because this audience, I'm guessing, cares about yields. A long-term, sort of multi-decade downtrend channel has been reversed for the 10-year Treasury yield. That said, it's really stalled in here. There's some resistance or a previous area of pressure, just above 3%. So this would be a very natural place from a technical standpoint for yields to take pause. And you can see how that could manifest itself on the sector front at least. And finally, on the US dollar, we've had a really nice relief rally in the US dollar, but from a technical perspective, based on my measures, if you look at that cloud or that blue shaded area, it's a counter trend move still. So we have to respect the downtrend that has been in place really since the beginning of 2017 and assume that there's some room for the dollar to weaken against a basket of major currencies. And I'll leave it there.
Go right into the microphone.
All right. So the slides. Okay, here we go. Chen, Common Advisors. Also, not really so much professor of math, more like student of math. So I will ask from a practitioner perspective, I will discuss how quant finance relates to stock market. And since I'm a money manager, so it's always buy versus sell decision making. So quant finance, the first quant fund, well, the big ones, started in 1982 when James Simons, a professor of math from Long Island, started this fund we all know as Renaissance. So it's been 3 decades or so, but we really don't know much about this quant world until maybe recently, in the recent years. So I'd like to start with introducing you to quant finance or quant funds. So what's a quant fund? Is it all math? All the numbers, maybe? Is it all programming, coding? Well, maybe. But if you really think about it, it's not just one or the other. And to my knowledge, there is no formal definition of a quant fund. Really, it's a broad industry. A fund can cover really just from as small as one factor fund to a very complex of coding, programming kind of fund. So what do we have? First of all, a quant fund can apply to any market out there. Equity, fixed income, currency, commodities, I mean, those are actually popular markets. Currency is the biggest one, honestly. And the derivatives are the popular vehicles for quant funds. That's how they can take advantage of the market, from options, warrants, to many, many things over here. And they do use lots of math at their foundations, also stats. Math-wise, you involve the log distribution to see how historically returns are distributed. And then you can also go a little bit further to Taylor series. Basically, if you're familiar with math, you want to find the derivatives from 1 to 3, all the derivatives. And if you go further, fixed income, nowadays, especially the convexity, which measures the change of the yield curve, the speed, is highly useful for this environment because we all know the interest rate is going one way, but how fast and how is it going to affect your portfolio? It's not just durations. You want to monitor the convexity. And Forex, because currencies all over the world is trading currencies 24/7, so you can trade the currencies very fast. And from portfolio management, you can combine that with your risk management. So that is really the quant structure over here. If you go even further, you can dig into models. So we have very simple models, the foundation of finance, which is the CAPM, and you can also build a binomial tree. Every time, every stage, is the price going to go up or down? If so, how much? Let's build a tree. After a certain while, you may just lose your track. So that is why you don't really go beyond a few steps. If you don't believe me, try 2 to the 8th to the 32nd or even more. Your calculator wouldn't be able to calculate that. So you have Black-Scholes formula, which is the Greeks, if you're a trader, those things, and that's really the binomial, the Greeks, they're here to try to avoid arbitrage opportunities. However, the irony is that quant funds use the arbitrage theories to find arbitrage opportunities, which I will discuss momentarily. Before we dive into that part, we'll just take a look at the development in quant funds. So we have automation, basically computer trading algo, all the machine learning, and the biggest funds include, as we all know, Man Group and D. Shaw, the famous David Shaw. And this year, it's supposed to be passing $1 trillion. If it hasn't, the estimate is that it's going to pass $1 trillion this year, and that is twice from 2015. As you can see here, in 2010, it was merely $200 billion industry. As of this year, it is really at 18% CAGR rate, so the growth rate is amazing, the AUM under this industry, albeit it involves large and small and different types of funds in the quant industry. So I would like to introduce you what types of quant funds there are. So the simple ones are factor models that quant funds like to use. They use some models. You may not be familiar with the models, but basically they watch a few things. For example, PE ratios. We all know PE ratios. You don't want to buy too expensive stocks, and you can also go with dividends. And some quant funds use macro levels, so they watch the economy going. And there are nuances out there. We all know that hedge funds like to monitor using their satellites or whatever, human labor on the ground. They can monitor the parking lot traffic. They can also monitor the electricity usage so that they can invest in the right industry or sectors. And sector models really just discuss one type of thing. How is it related to the market, this specific factor here? So if you do a factor model, it's really just how many betas you have and how much is it there over the minimum return, which is your risk-free return. And quant funds would like to get to know exactly what they're expecting in the future using their models. And ETFs nowadays are very popular, and there are many smart beta funds and ETFs. So one misconception is that, well, they call themselves smart betas or smart beta ETFs, and are they really that smart? So the definition is overused, honestly. So if you look at your cell phone, for example, if you look at your smartphone, there's an airplane mode. When it first came out, some people thought for a second maybe the airphone could fly if you put it to the airplane mode. So it's kind of misguiding here. The same as the smart beta. They're not really smart. It's really just they find one or a few factors and then invest in those factors. For example, you go to a low beta fund, basically they just go, or low risk fund, low volatility fund. They just go for the low market risk and nothing fancy there. And if you want to really look at the famous or the foundations of factor models out there, you can find the Fama French, which is really just explaining what's out there really behind the small portfolios or small stocks. Because Fama French, the Nobel Prize winner, they said that, well, if you buy the small stocks, you're facing some kind of risk and then you should be compensated accordingly. That is the small stock premium. And if you buy the book-to-market ratio, high book-to-market ratio stocks, then you should also be compensated with appropriate premiums out there. So they explain the factors behind the market returns. And this year, you cannot avoid the momentum this year, especially this year. As we all know that S&P 500 stocks, larger stocks out there in the US, and guess what, 98% of returns this year are driven by just a few stocks, FANG and Microsoft. So really, the momentum has been really piling on. That's why I said there can be really simple factor model funds. And that fund can just buy the top decile of the winners and sell the short the bottom decile of the losers. And that's why you see a crowded trade going into the winners this year. The winners just keep getting hotter and hotter because the momentum funds really catch up this year. All right, so arbitrage. Now we're talking about a little more complex level of quant funds. They like to use arbitrage to maximize their returns and minimize their risk. So it applies to all markets, by the way. We can go with stocks, commodities, or many, many things. And we call it statistical arbitrage or a startup. And what they do is, for example, the basic one is long short. You long something and short something to reach a neutral position. So if the market goes up or if the market goes down, you have something in your pocket. And the exposure is minimized, not zero, but it's minimized. So the systematic risk is still there. It's just that they want to minimize unnecessary risks. And if you're a great fund programmer or manager or a modeler, you may find some really close to zero risk out there with your arbitrage strategy. And this applies to market risk, geo risk, sector risk. It can be as small as a really small sector. And currency, of course, many global equity funds or global funds in general, they do not want to expose themselves too much to the currency risk, especially like we said, China this morning, just currency alone drags between 14 and 16 trillion dollars. And this is going to be something more statistical, so they watch the co-integration, at least the correlation among sectors or markets. And basically it's simple. If you see your neighbors buying something, you might be wondering, oh, should I be buying the same thing? At least I should think about it. So markets over time grow into co-integrated. So that's why I see the co-movements. If bond market falls, stock market is supposed to be, well, in the past, a long time ago, it was supposed to be the opposite direction. But nowadays, you kind of see the correlation. However, the correlation is not stable across time. During different markets, you may find high and low correlations. And you can apply to, all right, can apply to commodity, other things. And arbitrage basically, if I may quote the world's most interesting man, it's basically, I'll flip a coin, heads I win, tail you lose. So I want to do a bet that I will not lose. And who's interesting now, by the way. So you have these two types of funds you must discuss in quant world: high frequency trading and algo. So they take up over 0.5% volume, daily volume in the equity market. And what do? Speed, like a real estate. And if you didn't know, 1 second is about 1,000 milliseconds and 1,000,000 microseconds, and their unit is in the milliseconds. You blink your eye, it's about 300 to 400 milliseconds. But if you go further, well, they try to go with 10 milliseconds per transaction. That is really fast, and their processing time is only 400 microseconds. So you and our human beings are not competing against machines. That's not our same level field. In 2000, 8-month average shareholding period. In 2008, it was down to 2-month average shareholding period. And guess what? Nowadays, the average shareholding period is less than 20 seconds, and thanks to high frequency trading. And the firm actually built a straight line between NASDAQ and Chicago, which cost them $300 million, and that really just shaved off 3 milliseconds of their transaction time, and that's worth it. They go through mountains. And if we are, I'll actually go back one more thing. If we're looking at the time or the news, President Twitter nowadays gives us 20 tweets a day. But the funds, algo funds, they actually receive the tweets about 1,500 milliseconds ahead of us. And that's about years in the high frequency trading world. So we're not really competing on the same level. And some fun facts out there. Anybody has a guess? Well, given the time limit. Sharks are the headaches to hedge, or HFTs, because the transatlantic cables over the ocean must be in the deep water, so sharks are not attracted to the magnetic field, so they don't bite the wires in the cable in the water. So sharks, right? And you have US military grade technologies used in the quant fund world. And you have drone satellites being tested nowadays. They want to transmit their signals as fast as they can. And machine learning, by the way, what's machine learning? We have people from quant funds joining us today, and if you ask maybe in the future, what's machine learning? They cannot tell you exactly what their machine learned because they don't know. It's too fast the machine learns, and they change their learning fast. So the monitors, engineers are not aware of the machine learning all the time, so we don't know what the robots will do in the future. So I will pass the stochastics as Katie just discussed, and Basically, this is the chart that if you do a 10,000 times simulation of stock market, you can approximate where approximately this returns will be clustered in a certain market. Of course, you adjust your parameters to mimic the forecast. And nature is a wonderful thing. As you can see, there are uncanny nature or myth in the nature. So Fibonacci ratio is one of those things. If you follow golden ratio, I wrote a piece on golden ratio, give you a strategy. Just buy the stock equity, kind of like a golden ratio, 1.618, then you can outperform the market easily. Katie also talked about the fear and greed index. By the way, it's a great quantitative tool that if you're not familiar with it, just use the end result. And we basically want to use quant to analyze, understand human emotions. Exactly. When is the market oversold? When is the market overbought? Well, it's driven by human emotions. Otherwise, the market would remain neutral, not over. So that's the beauty of quant funds. Before, we didn't know if your father or mother was mad, but now we can analyze their behaviors, even their pupils, to see if they're really mad or not. And at Cumberland, of course, we do our proprietary quant analysis here. So we have a quant index or a quant fund strategy that tracks the market and tries to be a contrarian. So we buy the dips and sell the rebound. And we use Bayesian updating. If you have time afterwards, I'll be happy to share the Bayesian updating with you for 2.5 hours. But mainly what David and I are trying to avoid is that when you're greed and you buy, well, the next thing you look at is you're going to be fearful and you sell and repeat a couple of cycles and you'll be broke. So that's all I'm here to introduce you today. Hope you enjoyed it. Thank you.
Well, this is a pleasure to be here and to have heard so many esteemed speakers. My name is Alison Gardner. I'm with RBC, and I'm both a portfolio manager and a financial advisor. So that means that I have clients front and center. And I'm going to talk about the tactical management or the technology that I use, primarily point and figure and relative strength. So let's see. All right, let's. Obviously, I'm not technologically happy. Oh, okay, thank you. Down, excuse me. All right, starting out with clients, think about this. When you look over the last 225 years, we've really had only about 8 definable uptrend markets or downtrend markets. Now, if you had asked my stomach that, I probably would have said 22,000. But the idea is that any investor is probably going to be able to take advantage of only about 3 or 4 12 to 14-year trends in the stock market. As such, you're lucky if you get two good trends, but you really have to have some sort of strategy for dealing with the downtrends. And that's where point and figure and relative strength come in. When we talk about fundamentals, business school taught you fundamentals, taught me fundamentals, and those are things that are basically very quality-oriented and seem like common sense good ideas. For example, there's not enough clean water in the world. Well, that to me is a fundamentally great idea. However, the companies that clean water aren't always in favor. So if you can marry the fundamentally good idea, whether it be a rising dividend stock or clean water, along with technicals, you can really get an idea of outperformance in times that might not give you those. And it's just as easy as supply and demand. Point and figure has been around for a long time. As a matter of fact, it was first looked at by Charles Dow, who was the first editor of the Wall Street Journal. And what he realized was that anything that had a price, it didn't matter if it were a fig, a flying carpet, or a horseshoe, would resolve itself into supply and demand patterns. And that's worked for the last 225 years. Quite frankly, it's become popular with computers, not surprisingly. What used to take us doing by hand hours and hours and hours can now churn out 36,000 pieces of data on a nightly basis. And I show my clients the most basic patterns. Because I tend to be an optimist, I always look at the double top first. Do you remember when Union Carbide was in the Dow? Does anybody remember when you, thank you. I call this the Bhopal chart. When Bhopal happened and the plant, Union Carbide plant, basically blew up in India, Union Carbide went down from 45 to 31. That's represented on this particular point and figure chart with zeros as supply. And supply is basically sales in the market. There was, however, at 31, enough interest that people came in and bought just a little bit. So you can change columns to go from supply in zeros to demand in X's. Nothing really significant happened, however, and supply came in again before finally shaking out the loose or the weak holders and demand coming in. But this time, the demand exceeded the previous demand. And in point and figure charting, it's very simple. That is rules-based. You get a buy signal. The buy signal isn't infallible, but I'll tell you what, the probability of demand continuing in that particular indice, whether it be a stock, a bond, an index, a mutual fund, or a unit trust, is far greater when the signal's been given. The mirror opposite is a double bottom. Okay. There we go. Today's point and figure charts look like this. I'm not going to spend time on it. But I will say that, as Katie had indicated, we are a little bit more, I don't want to say timely, but the market from time to time demands that we be a little bit more short-term in looking at trends. And quite frankly, what we have found is that using several trends within a period of time can often be like 4 people running a relay and having a much better race time than if one person ran. So once a trend or a point and figure has been established, we just simply overlay relative strength. And relative strength is no different than the arm wrestling that goes, well, Wimbledon is on right now. And let's face it, if you looked at the top 5 seeds in Wimbledon, the chance of you predicting the winner out of that top 5 is probably a lot higher than if you chose the number 34 seed. It's no different in relative strength. And when Leo talked about fama in French, the factor research has shown that basically momentum or relative strength is one of the most additive factors to performance over time. And we'll go with that. It's basically Coke versus Pepsi. It's stocks versus bonds. This is where I use the relative strength and technical analysis. And that is when someone comes in and brings a portfolio that I may have for the next 30 years. We look at all the asset classes into which all of us in this room have the chance to invest and basically rank them. You know, the inventory is easy. If someone likes stocks, if someone likes ETFs, if someone likes mutual funds, It doesn't, if someone likes indexes, it doesn't matter. The inventory is custom tailored to the person who comes in. Then we overlay relative strength. And basically, when we rank each asset class, we come up with a picture that looks like this. And I don't know on these monitors whether or not you can see very closely. So let me just say that the asset classes go down on the left-hand side, and they are all assigned a buy signal relative to how they're performing when they're looked at within the context of the entire universe. At this particular point, and for the most part during the last 9 years, domestic equities is square in the #1 position. International equities had certainly rallied dramatically at the turn of the year, but with what the dollar has been doing, that has started to rotate quite a bit. And you'll see that having, in my work, that's got the most, it has the most twists and turns in it right now. Interestingly enough, commodities with oil, particularly, and energy fall into the third place. And I look at cash. Quite frankly, cash is similar in New York to going to the mattresses. Most people think if the market's going to go down, and when they talk about the market, they're talking about the financial markets, because my experience has told me that most people just say, there's bad news, get me out. So it's important to know whether or not cash is going to be accretive to your portfolio, which is why we do a relative strength on it. Yeah, okay. As Katie said, technical analysis works, but it doesn't work all the time and every single year, which is the measure by which we have to stand. And I will say that relative strength does not work as well if the asset classes do not have a wide dispersion. For example, if the top performing asset class is not very far from the bottom performing asset class, oftentimes you have to rely on fundamental analysis because you're not going to get through it with relative strength. And many of you may have seen that in 2016. Fortunately, in 2017, as both Katie and Leo said, sector rotation has worked very well, and that's primarily because we've had huge dispersion between asset classes. I will tell you, one of the things that drew me to the combination of point and figure and relative strength was going back and looking at various decades. In the decades of the 90s, if I put the test to you all, you would probably say 3/4 of the time the market did well. However, relative strength and point and figure kept anybody who watched it out of the market 96% of the time between 2000 and 2010. I know that my stomach would have been a lot better had that happened. And so far this year, we've been squarely in U.S. equities, this decade, for 87% of the time. Okay. So let's talk about technical analysis. What is it? It's rules-based. It doesn't require forecasting or prediction. And honestly, after the tech wreck and the financial crisis, having at least a seatbelt like technical analysis to put on portfolios has been terrific. So that's one of the reasons I use it. Clients are happy. I make them look at the little double top and double bottom charts, and we go from there. Thank you.
We have about 10 minutes. 10 minutes for questions. 2 microphones. I'll ask a question while anybody decides if they want to do the same. In 30 seconds, what is your best cell indicator? Katie?
I have to
Dun,
go to
dun, 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 dun.
the pressure. I use the DeMark indicators. There's a gentleman named Tom DeMark who's very well known in technical circles, and he's really just brilliant, and he's developed a suite of indicators that are really designed to understand not only what the prevailing trend is, but when it may inflect. And isn't that what we're trying to do at the end of the day, is try to understand when these trends may be maturing? It's one of his gauges is the closest thing that I've found to the best cell indicator to really being a coincident indicator. As you could imagine, because most of our indicators are moving average based, they're lagging by nature, but this one's very close to being coincident, and I find value in it.
DeMark indicator.
DeMark indicator.
Allison, best cell indicator.
I look at 5 technical indicators. I look at 5.
Go right into the mic so everybody can hear you.
All right. I look at 5 technical indicators. The most important one is the trend indicator. If that is negative, I do not hold it any longer.
Okay, best cell indicator.
You asked me to give our secret recipe away?
No secret sauce.
Okay. Well, the market complacency indicator, right, as we speak at Cumberland, when the market is getting too complacent, you want to sell because this is the time when the market is overpriced.
Okay, the complacency indicator is a mathematical way we measure sentiment to an extreme, and we're not going to tell you what the math is. Is that it? Okay.
Without your permission, I wouldn't.
One more round, and we'll open it up to anybody who wants to fire away, and they've got 30 seconds or less to answer. Alison, what do you use to admit an error? You made a mistake.
If it's on a buy, I have to sell it.
How do you know? And it's an epistemological question. How do you know when you know? What is it that trigger?
It can be a false breakout, quite frankly. And if it drops below the breakout point, that's a sell.
Okay. Katie?
Yeah, I mean, mine would be a breakdown. So we talked about support and resistance. When something that may have broken out or looks like it did, or has good momentum and then takes out a support level, that would be an indication that the trend is ending.
Leo?
Well,
You've never had an error,
It's
right?
the model that would make an error because I only use the model without discipline, so I wouldn't make the call over the model. But if the model didn't forecast the downward, say, correction, then the model would adjust itself and readjust the target price.
Okay. Questions from anybody? None. Doing a mathematical, technical, and go ahead, John, quickly. We got a microphone. We got about 3 minutes, Jill? 3 minutes.
Okay, one question. You've got so much machine interaction going on in the markets. 98% of the volume is machine driven. 2% is human driven. Does that change? How much does that change things from a technical standpoint?
Anybody? Machine?
Yeah, I'll answer this one. So right now, as I have shown you, right now we're not really trading the news. We're trading the post-announcement drift. In the past, when there was no machine, we were trading the announcement news. Now we're trading the drift, so it's different. So the price has been there. It's been fully priced by the machines at least, not by humans. Now humans just add on the repricing.
Comments?
I would
Closing
add
comment?
that, well,
Go ahead.
it definitely affects volume, of course. So I've found that volume, if you read the textbooks that were dated 30 years ago, volume was a really important component of technical analysis. And now it's just less so because the volume trends are not driven by the real forces, or real forces. Yeah.
And I'll look at supply and demand. Quite frankly, if you change from a demand to a supply and back to a demand column again, but you don't trigger a signal, that's just noise.
Thank you. Doing a panel on math and quant and technical analysis in 80 degrees in a tent after lunch is not an easy task. I'm sure you can appreciate that. And so this wonderful panel has worked very hard. I want to tell you that while they were looking at you and presenting, I was watching you too, and you validated all of the research done in a psychological study that was published at Princeton. He's laughing already, he knows it. At Princeton University, and they examined the relationship between speakers and audiences on all topics, and they found they were always the same, particularly after lunch. 25% of the audience sat up erect, paid close attention to the speaker, no matter what the subject was. And that happened here. 25% of the audience took a nap, went to sleep. And that happened here. And 50% of the audience lapsed into a dreamlike fantasy of some type. Princeton delved in the psychology department into that 50%, and they found that those people were contemplating sexual fantasies. So if we contributed to the pleasure of the half of you this afternoon, we're delighted to do it. Thank you.
Thank you.